a number of years ago, we did a major survey of venture capitalists that I'm going to mention in a few seconds. And what we decided is to repeat this to understand better, because while I talked to dozens of Silicon Valley venture capitalists and also some venture capitalists in New York and in London and Berlin, it was very important to get the gist of what the entire industry is thinking. And so we already have the machinery in place because we spent really several years trying to understand how to survey in the best possible scientific way. So we decided to implement this machinery to study venture capitalist thinking. Now, who are we? We is my three colleagues and I. They're all kind of part of this Stanford venture capital initiative that I mentioned before. Will Gornall is my former student, who is now a professor in Canada at the University of British Columbia. Paul Gompers is my colleague at Harvard Business School, and Steve Kaplan is my colleague at the University of Chicago. And the four of us did the survey a number of years ago, and now we decided to repeat the survey. And again, that was all done under the umbrella of our venture capital initiative. And so if you're really interested later on how to support it, then get back to Allegria or me. So when we started planning the survey originally, we were thinking basically whether COVID-19 will kill venture capital business model as we know it. And in fact, the very first publication by venture capitalists, by Sequoia, that said the black swan of 2020. And it was very, very negative. Or we were asking whether venture capital is going to be immune. And we ended up asking more than 70, 80 questions of venture capitalists to try to find out and tease it out from all possible angles. So we will survey over 1,000 venture capitalists. The venture capital industry is extremely important for the growth of the world economy. Many people don't really know about this. I have another piece of research that shows how important it really is for everything from the market caps of the world economy to our life. But it's a very small industry. In the world, there's maybe less than 5, 6, 7,000 venture capitalists who actually surveyed a non-trivial fraction of the entire body of all active venture capitalists. Now, timing is of course extremely important here because the events change day by day. So we conducted the survey in 2 weeks. So we spent about 6 weeks to prepare for the survey. And then we conducted it in 2 weeks. And as we discuss the results, I will comment also on what has been happening since then. Now, the moment I'm going to talk about what's happening since then, that's not based on the survey, but that's based on other factors, other data, and other interpretations I have. And as I mentioned, we did a huge survey, which was at the time the largest ever venture capital survey conducted back in 2015, 2016. So it also allowed us to compare how the industry changed in 5 years. So first of all, whom did we survey? We surveyed more than 1,000 individuals, mostly at the institutional, or as they're also called, traditional financial venture capital firms. But in fact, there are also a number of corporate venture capitalists, something we did not have in the previous survey, and that just showcases the importance that corporate venture capital has these days. So the main sample really is 800 venture capital firms and 112 corporate venture capital firms. We also had some other investors, mostly micro funds, angel seed funds, government funds, and so on. And the main results I'm going to show you are from the institutional and corporate venture capital firms. And what is very important to mention is that, first of all, more than 80% of people did complete the survey, even though it was a long survey. So if any of you completed the survey, I would like to thank you. And also very important to mention, as in the previous survey, the overwhelming majority of people did it themselves. And we included only those whom we knew to be decision makers, which is senior partners at venture capital firms, managing directors, and so on. So those who are really responsible for decision-making at venture capital firms. And we have most of the well-known Silicon Valley and American venture capital firms, 9 out of 10 top Silicon Valley firms, 35 out of top 50 global venture capital firms, and more from the US, which allows us also to split the samples by all possible slices and dices, industry, stage, location. So I won't be able to show you all the results. The paper is available, and I will ask Allegri to send you the link later on. So let us go to the results right away. The first result is the impact of COVID-19 on investment rates. So what I show you here is the normal based on the previous years. And for the first quarter of 2020 and the second of 2020, and that's basically down by about 30%, especially in the first quarter. So it was down by 30%, but it was not catastrophic as expected in March. In March, many VCs in Silicon Valley would tell me that we stopped doing any deals altogether. Now they're actually actively pursuing deals. In fact, the second quarter went up. Now the third quarter, we know it went up even further. And overall, at the time, venture capitalists expected a slow recovery, but the effect itself was not as material as initially expected. It was, perhaps not surprisingly, a much smaller decline in healthcare, and maybe more surprisingly, at least I was surprised by that, much small decline in early stage. So the decline in late stage venture capital investment was large, much larger, and is still large. So if I look at just recent results, large. In early stage, I initially expected to be a large effect because venture capitalists need really to see the management team. It's mostly about soft information, vague information. Well, what happened really is that by June, July, venture capitalists completely changed their business model, or at least the way they conduct business. And as I was looking at the results, I talked to dozens of venture capitalists, tried to understand or tease out the implications of that. And everybody was telling me exactly the opposite of what they were telling me in March, is that we actually feel now very comfortable interviewing the management team on Zoom. Yes, we would prefer to see them personally, but we figured out how to do this. And we have our virtual Zoom Monday partner meetings, and now Monday partner meetings can be, any day of the week partner meetings. Still, venture capitalists investing less. And the major reason, which is really important, is they struggle to evaluate deals. And it turns out to be that evaluating deals is more problematic for late stage. And that is because we did know from our previous research is that for late stage, you need more information. Obviously, there's more information, there's data room. And teams need to go into the management company, to go over the books, need to survey the suppliers, the consumers, and so on. So that the whole process is basically gets longer and more complicated and very often more costly. So that is late stage venture capitalists. What is really interesting is that some evidence indicates is that many venture capitalists prefer to reduce their investment, not because they struggle to evaluate deals, especially in early stage, but because they think there will be more deals coming along very soon. Everybody expects the overall entrepreneurship rates to go up, the overall startup creation rate to go up dramatically. And so many venture capitalists prefer to wait, something that I call real options. So those who were my students in the past remember those words, real option strategy, so that they can conserve their capital and implement that capital, infuse that capital into better startups. I'll talk a little more about the capital because there's actually really interesting findings there. But one I can already mention right away is that conserving dry powder turned out to be really important for corporate venture capitalists. And especially for corporate venture capitalists, the relationship between them and their partners, so their parent companies, changed a lot and suggested a much firmer, much stricter capital constraints. In fact, many corporate venture capitalists I talk in March, but also more later, told me that we're now on freeze, not because we don't want to invest, not because we have difficulty finding fantastic deals, but because our parent company basically stopped us doing so. And I think this is one of those cases where whether you are on the balance sheet, so that you really have to go back to your parent company and ask permission to invest, or you're off the balance sheet where you have a budget allocation, but you don't need to go and ask for each investment, became really critical. Again, what is important is that not many people mentioned that there are no entrepreneurs, there are no quality entrepreneurs, or it is difficult to meet with entrepreneurs, and that's why it is a problem. So I mentioned capital, and the cost of capital is very important. Comparing to 2016, the required internal rate of return actually did not go up as much, from 31% in 2016 to 34% during COVID. Now, it's kind of about 10% increase, so it's non-trivial. But one possibility is that that increase is secular rather than just occurred during COVID. So there are several possibilities for this. And one, I already mentioned, tighter capital constraints. For the institutional venture capital firms, the required IRR, I will show you later, in fact, increased less. Second is that I think a lot of venture capitalists perceived that there will be more riskier deals coming along. And as a result, when risk goes up or uncertainty of more startups failing, they would require higher IRR. And we also know from finance is that if you prefer to wait, so if you have an option to wait, let's say you have a good deal, but you think that a better deal will come in a couple of months, you wait, but meanwhile your required IRR goes up, because in that couple of months you will not be getting your return. So the future IRR should go up to compensate for this waiting. What I think we found really interesting is that a minority of venture capitalists, but a sizable minority, claimed that limited partners, so that is institutional venture capitalists, requested from them fewer capital calls. And so those venture capitalists were particularly constrained that got contacted by limited partners and asked not to request capital calls because limited partners face their own capital constraints, their own liquidity challenges. Now, this is really interesting because when I was developing my venture capital course at Stanford and teaching that, one of the big claims I always had when we talked about the economics of the venture capital funds is that it is important to diversify your limited partner base. If you have only one LP or one type of LPs, that's dangerous because most of the time nothing happens, but if something unpleasant happens, then it might happen to all your LPs at the same time. And I think that's what's happening here. So I made calls to a number of venture capitalists after this result. And I think we found that those venture capitalists with more diversified LP base had much less of a problem than those VCs that had only one LP or had only one type of LP. This also explains the challenge that corporate venture capital funds face because they typically have only one LP, only one parent company. Now let's talk about the valuations. Obviously, we asked a lot of questions about venture capitalists thinking about how valuations of early stage or late stage are going to be impacted. Most venture capitalists thought that valuations would be down by 20%. By the way, I find it very interesting because that was back in June. Now we're in October and I can go back and check the actual deals that happened in July, August. The valuations are down, at least in Silicon Valley, for which we have data. The valuations are down, especially in early stage, as suggested, as predicted by venture capitalists. So venture capitalists can in fact predict short-term fluctuations in valuations pretty well. The valuations are down both in healthcare and in IT. And majority of venture capitalists expected contracts to be more investor friendly. And As we know, venture capital contracts are very, very complicated. And there are many, many terms that can be either more investor friendly or more founder friendly or more company friendly. And majority of venture capital expected contracts to be more investor friendly. And I'll show you this slide, which I think is one of the most interesting. You can see it in the paper, but you also can kind of just print screen if you would like to study it later on. So what is here? This is explanation. So first of all, we'll look at 5 various contractual terms that back in 5 years ago, when we studied contractual terms, we found that venture capitalists found some of those terms important. Now, all those terms are very founder unfriendly. So if, for example, venture capitalists have 2x liquidation preference or full ratchet or cumulative dividends or redemption rights or particularly strict redemption rights or participation, those are all examples of founder unfriendly terms. And on the horizontal axis, what you see is the term usage. So what's really it means is that venture capitalists who preferred or would love to use the terms or would love to negotiate the terms. And the red is the theory from 5 years ago, and bluish is the today's theory. So even though venture capitalists told us that the terms would be investor friendly in the summer of 2020, in fact, over the last 5 years, terms changed dramatically to be more founder friendly. So to give you one just example, if you go to the very first row, at least 2x liquidation preference. Back in 2015, 20% of venture capitalists would like to get 2x or more liquidation preference. And if you're an active venture capitalist, I think you know that these days it's very difficult to get this unless the company is in a down round or in an unusual situation. So these days we have 10%. And if you're in Silicon Valley, you'll say 10%, that might be 0%. Well, remember, this is global venture capital, and the East Coast, for those of you on the East Coast, in Massachusetts, in New York, and North Carolina, those terms actually tend to be more investor friendly. We found this back 5 years ago and today. So this is the general result. But overall, as you move to the left on this diagram, you become much more founder friendly. And so the last 5 years, despite COVID-19, the terms became much more founder friendly. So now going to today, I reviewed some recent contracts that we just received for the summer. And indeed, the results show that maybe you see some terms that are investor friendly compared to a year ago, but compared to 5 years ago, the terms are very, very much founder friendly. So far, COVID-19 didn't have a very substantial impact on venture capital contracts. We also asked questions about idiosyncratic impact on individual portfolio companies. What I mean by that is that we basically asked venture capitalists, so you have a large portfolio. In your portfolio, how many companies do you expect to be negatively affected, very negatively or positively affected by the pandemic? And then we averaged all of this. So this is kind of, if you think about this, if you have one large portfolio of all venture capital backed companies, of all our respondents, those are thousands and thousands of companies. So the results were very surprising, I think, is that only 10% of portfolio companies are very negatively affected. Now, very negatively affected basically means that the company is failing or about to fail, about to be closed, liquidated, and so on. So that's very surprising, because in a normal year, without any COVID implications, I would say 10% also would be a reasonable estimate. 1 out of 10 companies, maybe even more, just suffering greatly. We have 4 out of 10 companies that are negatively affected, but then half of the companies are either not affected or positively affected. In fact, again, when I talked to a number of venture capitalists later and more recently, they were telling me that even compared to the summer, more and more of their portfolio companies are either less affected, positively affected, or improving their condition. And so overall, the venture capital industry, I think, is having a better time compared to many, many other industries, potentially even including some of their larger technological competitors. What about the impact on funds? So we looked at the overall change on the two financial metrics that venture capitalists use and their LPs use, cash-on-cash multiples and the IRR. So the cash-on-cash multiples basically reduce on average by 0.07, which is a very small number. The IRR by 1.6, which again is a relatively small number. So overall, the venture capitalists do not expect to have a large impact of COVID on their financial performance of their currently active funds. Now, at the same time, there was a high volatility among venture capital funds. So there were a number of funds that reported having really hard times. And their cash-on-cash multiple were down by, on average, 0.85, which is a large number. And then there were a number of funds that were really improved as a result of COVID-19, and their cash-on-cash multiples were up by 1.2, which is very large, again up. So it's still too early to say whether venture capitalists could predict, which I find really amazing. So we know the identities of those venture capital firms. We have 800 of them, remember, and we can go back several years down the road and check whether venture capitalists, on average, can predict how their cash-on-cash multiples. We also have, of course, a lot of other predictions in terms of IRR and how many companies will go public and so on. So what they can predict, but so far I don't have results on that. But what we have is that venture capitalists differ a lot by how they expect the pandemic is going to affect them. And so what was really interesting, as with winners, as with companies that, half the companies, portfolio companies are expected to be positively affected, what's happening is that even though many venture capital funds think that they are going to be losers in terms of the effect of the pandemic, winners overwhelm losers. So more venture capital funds are more optimistic as a result of the pandemic. Back 5 years ago, we were very much interested in how venture capitalists spend their week. When I present this to my MBA students, I'm actually teaching my MBA class on venture capital right now. Students always love this graph, that how venture capitalists spend their week, because most students, and I have to say most people, I think that venture capital is a very glamorous profession where mostly you network, go to cocktail parties, and also maybe meet entrepreneurs. So those of you who are VCs here, I know that it's a little bit further from the truth, which is venture capitalists spend most of their time actually assisting portfolio companies. Well, first of all, they work a lot. The average week is about 55 hours, but they most of the time they help their active portfolio companies, and they did increase during the COVID-19, which is not surprising. They also spend quite a bit of time managing their venture capital firm, and again, that increased quite a lot during the COVID. In terms of percentage changes, the largest increase is meeting or communicating with their investors, and I think that's not surprising. They didn't change time they spent on sourcing the deals. So what they spend less time is networking. So they don't go to cocktail parties, and I guess meetings on Zooms are either more efficient or you just don't participate in them. And so instead of networking, they just assist portfolio companies and manage their venture capital firm more. Overall, they also work more by several hours compared to 5 years ago. So overall, I think maybe that's what we expected, but still the results are interesting in terms of how many hours on average they spend. Now, because they spent most of their time assisting portfolio companies, we also asked exactly what they do. I think you will find, especially if you're a venture capital here, venture capitalists, you will find this very interesting. And you can kind of benchmark yourself against this. So first of all, venture capital is saying that just in the past 6 weeks, and we're asked about past 6 weeks because that was back in June, July, this more or less the start of the pandemic. They're guiding their portfolio companies quite a lot, providing strategic guiding, operational guiding. They help reduce their burn rate. That is a big change from 5 years ago. They also connect. They connect with equity investors, with liquidity, with customers, and also with COVID-19 relief. But they're doing less than 5 years ago. 5 years ago, they reported they were very influential or participated a lot in hiring people, managers, employees, firing employees, board members, and so on. These days, they're still engaged, but less so. And geography overall is predictive on some level. So there is differences between West Coast, for example, and East Coast. But the COVID-19 effect was not predictive at all. So we spent days and days getting COVID-19 statistics. And I would like to thank my colleagues at the Stanford Medical School who provided me a lot of data at the time, at the deaths, infections, hospitalizations, and so on and so forth. And so it wasn't really related to anything. So we did it for the US, we did it globally. What you show here is on the left is the US population, on the right is our survey respondents. So obviously we have more respondents in California than anywhere else. Also New York and Massachusetts, which is not surprising, and Illinois, which is Chicago. Again, not surprising. So within California, also there's a difference between, of course, Southern California, Northern California, but again, we didn't see any response. So almost none of the questions that were asked, and again, we asked 70, 80 plus questions, the geographical difference with respect to pandemic was not influential at all. But I would like to emphasize that there was a big difference in the geographical difference. So California is very different from the East Coast, and the US is quite different from Europe and so on. It's just that the pandemic response didn't impact at all. So this is briefly what I want to share about the results of the survey. But let me mention now, and I see there are some questions, and if you have any questions, prepare to ask them. But let me mention what happened since then, because I think that's kind of interesting. I've been doing a lot of research for the past several months on what's happening in the technological innovation in Silicon Valley and elsewhere. And one of the reasons I already mentioned, I'm working a lot with large companies around the US, outside the US, in Europe, in South America, in Asia, in the Middle East. And what large companies now are very worried about, and more worried with every single day, is that their industries that often were very traditional industries that have not really been affected by technology that much or disrupted by technology. Now there's disruption happening in every single industry. And so what we'll be looking at is the proliferation of startups in industries where, 10 years ago, Silicon Valley did not participate at all, including biotechnology, where Silicon Valley was active, but not in specific fields of biotechnology or healthcare, in educational technology, in government or regulation technology, in energy technology, in agricultural technology, food tech, agri-tech, in mining, in real estate construction. And I can continue the list of industries that, up to recently have not really been impacted by technology, or rather technology was helping them. And in every single industry, this is what we found. First is that I cannot now name a single industry where there would be no startups, either in Silicon Valley or either innovation ecosystems, that try to disrupt the industry. Most of those startups are small, going to be unsuccessful, untried business models, but they're trying. And there are two major reasons behind that. First is that there is a co-influence of a number of technologies and economic mechanisms that came together over the past several years, where now it's much easier to experiment. We see this at Stanford in our startup garage. We see it everywhere around Silicon Valley, just cheaper, easier to experiment. It's much faster to realize whether it's working out or it doesn't work out. And if it's working out, it's much easier to raise funding and much easier to scale right away. Just a couple of weeks ago, I did a workshop for a large company, a huge company that all of you know, in a sector that is related to agriculture or food. And I gave them some examples of startups that they even haven't heard about that is interesting. But I also gave an example of a company that everybody now knows about, and I'm sure that everybody of here, every single of you knows about or heard about Impossible Food. The company that is making non-meat burgers that kind of taste like meat, looks like meat, touch like meat, and so on. But the reason I gave this example is because what is less known is the speed at which that happened. Back in 2015, nobody ever heard about Impossible Foods. It was created out of Stanford using Stanford technology by a Stanford professor. And then in 2015, and then actually technology is not new as I understand. It just was not possible to commercialize. Invention and innovation are two different terms. And just in 2015, the first burger, Impossible Burger, was created, but it might have cost $20 million. In 2016, they already started commercializing. In 2017, they started building their factory in Redwood City, in Auckland. In 2018, they started building commercial relationships with large suppliers in the food chain. And in 2019, they started really scaling up. And in 2020, and I found this really amazing. When I present this, I show a slide which is really, I think, impressive. Their business model is very simple, relatively simple. You build a burger and you try to find kind of McDonald's of this world who is going to buy it from you. So it's B2B business. And they converted from B2B to B2C within a month. So now you can buy impossible stuff online. So this all happened in the course of 5 years. It all happened at a relatively low level of capital, not billions of dollars or just hundreds of millions of dollars. And I think that's very impressive. And the same is happening in every single industry. Now, the impact of COVID-19, based on everything I've been seeing, is going to accelerate that for a number of reasons. First, valuations are down, as I already mentioned. And as a result, it's easier to invest. There are more startups. Many venture capitalists comment, and I'm saying this, there's never been just more startups that are trying something new. That's in fact behind, I think, real optionality where venture capitalists would like to stop and think about how to spread their bets, because they think there will be even more interesting startups. And this technological acceleration is going to be felt around the globe. By one statistic which I find amazing. So we're doing now research, very interesting. I hope to share this with you at some point later, this year or next year, about corporate venture capital. Just 5 years ago, when I started getting interested in CVC, it was a very small, relatively unimportant field of less than 300 companies, and not all, and many of them were really not doing this actively. Now we have more than 1,500 global corporate venture capital funds. And I just talked maybe to 20 companies over the past several months. By the way, I found Zoom workshops to be as effective as real workshops. So just maybe 20 companies, global companies that are just about to start corporate venture capital, and we talk to them about how to do it. So that is, I think, going to lead to a huge increase in investment in innovation around the world. So I actually expect more startups and more innovation, not less, over the next couple of years. So on this note, let me stop. And Allegra, I'll be very happy to answer any questions.
You may have touched upon this already, but can you speak a little bit more on industries apart from health or IT in terms of valuation?
Industry apart from, so first of all, the valuations declined more or less equally across all the industries. I mentioned healthcare and IT is because in research, the sample size is important, and only healthcare and IT is large enough so that we can show it very statistically significantly. But if you looked at all the other industries, the valuations were down across the board by about 20–25%. And I don't believe that there was a single space that we looked at, and we really tried to slice it in various spaces, various ways, that experienced either no change in valuation or an increase in valuation. Now, going to October, I think that the late stage valuations are now affected more than early stage valuations back in July. So we are seeing some late stage companies that are raising at lower, at least post-money valuations than we expected back in July.
Great. Another question that came in, are you researching the impact of COVID on diversity in the VC ecosystem? That's
a very good question. Well, first of all, we are at the Venture Capital Initiative doing a lot of research on diversity to start with. And we already published one piece that you can look at that I already presented at the prior Venture Capital Initiative forum. And we're now doing more research on this. It's actually not that easy to do. The diversity is a huge issue in the venture capital community. So the impact of COVID-19 on diversity is just too early to study right now because this data is not there yet, because this requires empirical data on effectively hirings in the venture capital firms and the types of companies that they invested in. Now, what I can see is that there are more startups that are trying to raise money that are more diversity, the more diversified in terms of diversity criteria that are important. We don't yet know whether they are more or less likely to raise funding. There are also more diversity funds, both at the seed stage, or the angel stage, and at the early stage. And this is where really the bottleneck is. We know this. But that is not by itself the impact of COVID-19. That started before that. What I think is important to mention is that maybe COVID-19 has not stopped it. But again, it's too early to say, but we're going to study this. So stay tuned.
Great. We have Jamal raising his hand. Jamal?
Hi, Jamal. Nice seeing you.
Hey, nice to see you. I'm GSB05. Thanks for all of your great work here. Just a question about the age of the startup when it comes to VC appetite. Has your research touched on whether a team that's been together for a year and is coming for money is more attractive than a team that's been working at it for 5 to 7 years, maybe took longer, but has a good product?
Right. So that's a good question. So first of all, let me mention that there are two trends here of the past 5 years that go in the opposite direction that the research shows. The first trend I already mentioned is that it is easier now to scale up. It is easier to test and experiment, at least in most fields. And as a result, this trend basically says, well, we're going to raise venture capital stages funding quicker. There's another trend though, is that the funding at the very early stage undergone dramatic changes. So, when you graduated, Jamal, in 2005, that was actually my first year at the GSB. And I still remember my very first students. And I remember two of them very well, who became friends, who wanted to raise, who were entrepreneurs and or wanted to become entrepreneurs, had a great idea. So they needed to raise several $1 million from venture capital funds just to build a prototype and hire engineers, buy a very expensive Oracle system, and so on and so forth, okay? And after spending $3, $4, or $5 million, they just got a prototype and had to raise another money. So back in 2005, difficult to think about this. The word angel was not really used in Silicon Valley, just because if you had $50,000, you couldn't do much with them. So these days, Jamal, your colleagues, your peers who are graduating this year or last year, they don't need to go for venture capital funding right away. So the second trend is that not only you raise the first angel round of $200,000, $300,000, $400,000, $500,000, and that gets you to a prototype, to your first customer, to your first revenue, and so on. But what's happening these days, more and more, is that the first angel round is followed by another angel round, and by another angel round. And as a result, this trend means that companies, in fact, raise venture capital funds later. And so we have, as a result, this bifurcation. Some companies, in fact, delay raising venture capital funds, venture capital funding, until much later. And some other companies that scale up very fast, or in the fields where angels are still not sufficiently large, like say robotics or space tech, they tend to raise venture capital funding much faster. I think Nicola, hi Nicola, nice seeing you again.
Hello, Ilya.
Go ahead.
Thank you for the presentation. I was wondering if you could share what you think was the biggest differences between financial VCs and corporate VCs from what you presented.
The single biggest difference was that corporate VCs were projecting that they're going to invest much less because their corporate parents basically told them to freeze. That was the single biggest difference. Okay. And within corporate VCs, you could see that a very clear distinction. Those that had to get their parent approval for deals had the biggest impact. So if you look at that subsample of corporate VCs, then they had, that is the single biggest anomaly of all the venture capital surveyed respondents. And I think that, when I talk about institutional VCs, they're all very different, all of them are unique, but at the same time, they're similar along so many aspects. When we talk about corporate VCs, they're all unique, every single one of them. And there are so many differences among them. And the single biggest one is to what extent they're free to make their own decisions. And whether they're on an annual allocation, quarterly allocation, 5-year allocation, separate fund allocation, and so on. So some corporate VCs are in fact not that different from institutional VCs. They have one LP, okay, sometimes actually even more. But apart from that, it's like an LP. But some corporate VCs are really a business unit of their company, and I think that is the single biggest difference.
Thank you.
From the chat, you mentioned that investors were expecting an increase in the number of startups later in the year. Has this actually been happening?
From what we see so far, the answer is yes. It's not in terms of startup funding that we see, but in terms of startups that are trying to raise funding. There's an increase along the board of all startups. And I don't have good data on exactly what is behind that. But explanations are that many people are sitting at home and have just more time to explore various ideas. Second is that many people are relocating, and again, any change in your life makes you explore ideas. Third is that I think COVID-19 changed the business models and thinking of many people that gave impetus to change the world. So this is, again, I don't have good statistical data, but I'm talking to a lot of students, past students and so on, and I've never seen so many ideas that got generated out of pandemic. Now, they're not related directly to COVID-19, not, just building a new vaccine or whatever, but it's because this huge change made people realize that, oh, you can be creative in a completely different way. And as a result, they generated a lot of interesting ideas. Many of them are not directly related to COVID-19 at all, but I think became possible only and only because of the change in the environment. So overall, I see a dramatic increase in the startup ideas. So whether it is going to translate into the actual number of startups being funded later on, we'll have to see.
Has COVID changed the way valuations are done? Are certain factors given larger importance now?
That is a very good question. So first of all, from the survey, we asked about what kind of valuation methods they venture capitalists use, and there was no change from 5 years ago. So at least back in June, July, they used exactly the same valuation methods that they used back in 2015, which by itself is not surprising. Now, I think that especially in late stages, for late stage companies, there were two or maybe mezzanine stages. I think the biggest change that is always happening during any crisis is that liquidity suddenly becomes a big issue. Because if you look back at the internet bust of the early 2000s, or the financial crisis of 2008, 2009, 2010, what really happened was that those startups survived and succeeded who had enough cash, liquidity, or who could reduce their cash burn rate dramatically. Now, they not only survived, but they became much more successful. And the reason being is that if their competitor did not survive, then, well, they had one competitor less. Second, they could acquire the talent from the competitor potentially even cheaper and could acquire other assets of those competitors. So suddenly you have in a less competitive environment as a result of the liquidity crunch, as long as you are not the victim. And so as a result, I think the biggest change in valuations, but not about COVID-19 per se, but about the crisis feeling and state, is that liquidity suddenly becomes a much more important topic. So that venture capitalists try to save dry powder, as I already mentioned, so that they can help their startups. They try to help, as I already mentioned, to make sure that their startups are not burning cash that much. Again, back in 2015, that was not an important reason at all. 2015 was not a crisis year. 2016 was not a crisis year. And in terms of valuation, the factor, which is how much money does this startup needs to reach its next milestone, so to raise its next round of funding, or over the next 12 to 18 months, I think it's just becoming a more important factor in terms of the decision to fund and in terms of the valuation.
Thank you so much for joining us, Professor Strebulaev. Thank you all for joining us and have a great rest of your day.
Thank you, Allegra. Thanks everybody for joining. It is really nice to see both faces and people's names. I recognize many. It's really very, very impressive. Please keep in touch. Send me an email. Send me a LinkedIn message. It will be really great to get in touch with you. Thank you, everybody. Bye for now.
Thank you.
Thank you.
Goodbye.
Thank you.